Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video we're going to go through the question, how far out should I place trades? So generally speaking, we prefer shorter duration or timeline trading whenever possible, meaning we prefer always to hold trades as short of an amount of time as possible. That doesn't necessarily mean that the shortest time period is the best. It just means that we do prefer to hold trades for as little time as possible and not have money exposed and at risk. Now, right now, at the time that we're doing this video, our average holding period for all trades that we have is 27 days. That's the amount of time that we're holding each trade on average. So we could enter a trade, let's say, 60 days out and then close it after it's been working for 30 days. Okay, so we still have 30 days left until expiration, but we closed it and held it for 30 days after entering the trade for 60 days or 60 days out. Okay, so for us, that's usually about a pretty good average where we want to be around. We kind of want to be around that 30 area. So we're holding trades a little less than average right now, which is good. You can always check our updated performance on the live portfolio stats page right on Option Alpha. Now, whenever we determine how far out to place trades, though, when we're looking at new strategies, we should be mindful of how an options price is affected by theta and vega. So before we get into some examples, I want to go through another reminder in case you don't know, or in case you do know, it's probably helpful to understand it again, the impact that time decay and theta and volatility or vega has on an options price. Now remember that as we near expiration, so as we get closer to expiration, so we're 60 days out, 90 days out, 30 days out, etc., an options price is going to go down in an exponential fashion. So it's going to go very slow as it's further out, and then as it nears expiration, the rate at which the value declines in the options price is going to speed up exponentially until it hits zero at expiration. Okay, again, this is that extrinsic or time value of an option, and mainly this is derived through theta and vega or volatility. Okay, the sweet spot is really somewhere around 40 to 45 days here. That's when kind of time decay is at its optimal rate or starts really accelerating at an optimal kind of peak. And so that's ideally where we want to be placing a lot of our short premium trades, is around that 40 to 45 day mark. Okay, but again, it's just important to understand how time decay affects an options position. Likewise, it's also important to realize that implied volatility or vega has a big impact depending on how far out an option's expiration date is. So if we're looking at two different contracts, one contract has 30 days until expiration. If that option contract cost $1.50, that vega in that contract, or the volatility impact of just a 1% move up in implied volatility, might only be $3. Okay, it's 30 days away. So a large jump in volatility, let's call it 3, 4, 5%, is not going to impact the value of that option that much, because each 1% move up in implied volatility only impacts the value of that option by $3. Okay, so the closer you get in timeline, the smaller the impact of rising implied volatility, or really falling implied volatility, is as well. As you get further out in timeline, let's say an option that's really far out, just to kind of prove the point here, 365 days out, and the option may cost on the outside $536 because of the time that's added in there, you might be looking at a vega of 0.2. So again, that same 1% move up in volatility now has a much more dramatic impact on the option's value in the future, because it's going to be spread out over a longer period of time. That volatility is going to have 365 days to now play out versus 30 days to play out. Okay, so again, it's important to understand this concept. So as we here at Option Alpha look at an options timeline out into the future, one day being 1 day until expiration, 30 days until expiration, 60, and then everything kind of beyond 60, our sweet spot, like we talked about before, is right around 45 days to place a trade. Okay, so placing a trade around 45 days, mainly as option sellers, which we are, that's usually what we want to be doing, is placing trades around 45 days. And then more often than not, we close them out somewhere around 15 days. And I think this is an important concept because we do manage a lot of our trades early. We do close them early. we are deliberately trying to close positions and take profits early, which means that we don't typically hold a lot of our portfolio in closer to expiration, which means that we're not subject to a lot of assignment and expiration risk, holding a lot of positions all the way to expiration. If we need to hold a position through expiration to see if it works, we will, but we don't like to do that. We don't generally do that as a course of trading and business. So most of our stuff is placed around 45 days and then closed around 15 days. Some stuff might be placed at 45, closed at 30, etc., etc., etc. The way that you want to kind of think about your options trading in general is that everything basically around the 25 to 40 day mark is really the sweet spot for option selling. Okay, so this is where you want to be doing a lot of your option selling strategies or net selling strategies. And the reason that you want to do that is because during this window, time decay is at its highest peak or is increasing at its fastest rate every single day. And because the impact of being wrong on volatility, meaning that if we're an option seller and volatility goes up, that's a bad thing for us. The impact of volatility going higher is going to be very, very small on our positions. So the negative impact of being wrong directionally in volatility, which we should be pretty right in our directional assumption of volatility if we know that implied volatility is high and we're going to be option sellers. But if we are wrong and option implied volatility goes even higher, that impact is going to be as small as possible and mainly offset by the fact that time decay is increasing at an exponential rate. Okay? If we are looking to be option buyers, then at that point, we really want to be kind of working 45 days plus, okay? And I say even go out to, say, 60 or 70 days out. For us, really 80 days out might be too far, okay? That might be really kind of too far on the further extremes and edges. But really, we want to be working 45 days to 60 days or so, maybe 70 days out for how far out to place trades. Again, when you are buying options. And the reason that we want to do that now is because think about your strategy heading into an option buying scenario. You are hopefully looking for an increase in volatility or a move up in volatility, or you wouldn't be buying options assuming that they're already implied volatility is already low. And you also want to do that realizing that your option is a wasting asset. So if you bought an option for, let's say, $1.50, you want to make sure that it's worth more than $1.50 at the time that you close out the position. So if time decay is a big factor and is slowly eroding away the value of that option, then we want time decay's impact to be as minimal as possible. So that's why on these option trades where we're a little bit further out, we want to have a small impact of time decay against our option, and we want to have as large of an impact as possible on being right in the directional move of volatility. Because again, the further out that our initial position is, the greater that implied volatility will be a profit maker for us in that strategy. Okay, so again, we want to play towards these strengths as we look at the timeline for placing trades. So generally speaking, if we kind of look at it graphically and with different strategies, we generally want to be placing trades like strangles and iron condors and straddles. All of our short premium strategies, we kind of want to be centered around this 25 to 45 day window. Okay, anything really longer than that, and so anything further out than that, we want to be doing the long option strategies. So these are ratio spreads, debit spreads, calendars would be in this category as well. You want to be doing those out a little bit further. Remember, option pricing is cheap, so we want to lock in the timeline, as much time as possible to be right in our directional assumption when option pricing is cheap, and we can do those net buying strategies like doing ratio spreads and debit spreads, etc. All right, so we want to make sure that we're always cognizant of that time period. Now, we do have a free ultimate strategy guide right here at Option Alpha. It breaks down every single option strategy that we use and the optimal time period to enter that position. So I would encourage you to check it out. Again, it's totally free. You don't have to pay for it. We wrote that guide. It's been recently updated. So it basically tells you, hey, look, if you're going to do an iron condor trade, you want to place it XYZ days out into the future. Or if you do a ratio spread, you're going to want to place it XYZ days out into the future as kind of your optimal entry point. So again, as much as possible, let's always play to the strengths of the market. Let's realize that when volatility is high and we can come in a little bit closer and time decay is on our side or increasing at an exponential rate, we want to be option sellers versus the alternative. So as a just general rule here, we want to be net buyers when our smallest edge is present in the market, meaning when volatility is lowest, we want to be a net buyer. And if we have a small edge, therefore we need to compensate for that small edge that we have in pricing by trying to get more time or a longer duration trade, meaning entering the trade with 60 days so that it has 2 full months to maybe swing into the direction that we need it to before we end up taking the trade off for a profit. If we want to be net sellers, we realize that we have the largest possible pricing edge right at that moment because implied volatility is high. Therefore, we want to force the market to make a move that's out of the ordinary, meaning we want to enter our trades with generally less time. So around 45 days is kind of like the starting point for how we do that. That's the optimal point. Does that mean that if we get into a trade and the contract months are, let's say there's the closest contract month has 41 days, that we won't trade it? No, of course we'll trade it at 41 days. We ideally love to do it around 45 days, but we'll do something as low as, say, 25 days in time. Okay, so something around that 27, 30 days that we were talking about earlier. But remember, our edge is greatest. We want to force the market to make a move that's out of the ordinary and basically turn our position from a profit into a winner. And that's why I love option selling so much, is because you force the market to make a move it doesn't normally do versus trying to buy as much time as a net buyer. You try to buy as much time as possible to hope that you're right and that the market swings into your favor. Okay? So again, this is really key. Net buyers, you want to do more time, longer duration or longer timeline trades. Net sellers or net selling strategies, you want to have less time, force the market to make a move that it doesn't usually do. So as always, hope you guys enjoy these videos. If you have any comments or questions, please leave them right below in the comment box. If you have any feedback or anything that you want me to discuss as strategy, again, ask it right below in the comment section. If you love this video, please share it online. Help spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.